For decades, COMEX worked the same way. Millions of ounces of gold changed hands every day, yet almost nobody actually wanted the metal. They wanted exposure to the price, not delivery. But now something has changed. Record numbers of investors are demanding physical gold, instead of simply trading paper contracts. Even months that are normally quiet have seen delivery activity surge, and here's why that matters. When institutions stop trusting price alone and start competing for possession, they're sending a signal that's much bigger than gold. They're revealing how they see the future of the global financial system. The average investor is still glued to stock charts, meme stocks, and social media predictions, while some of the world's biggest financial players are quietly changing their behavior. Think about it. If you ordered a pizza and the restaurant kept offering you coupons instead of the pizza, eventually you'd stop asking for coupons and demand the actual pizza. Sounds ridiculous, right? Yet that's surprisingly similar to what's making headlines in the precious metals market today. So what exactly happened at COMEX? Why are experienced investors paying attention? And more importantly, what does this tell us about protecting and building wealth over the next decade? Because this story isn't really about gold. It's about confidence. And history has shown that when confidence begins to shift, the people who recognize it early are often the ones who come out ahead. Before we can understand why investors are paying such close attention to COMEX today, we need to understand what COMEX actually is. Most people hear the word COMEX and imagine a giant vault filled with stacks of gold bars, changing hands every minute. It sounds dramatic, but that's not how it works. COMEX, short for the Commodity Exchange, is one of the world's largest futures markets for precious metals. Think of it as a marketplace where buyers and sellers agree today on a price for gold or silver that can be settled at a future date. It's less like a jewelry store and more like a financial agreement. When someone buys a gold futures contract, they're not usually buying a shiny gold bar to put in a safe. They're buying exposure to the price of gold. If gold rises, they profit. If it falls, they lose. For hedge funds, banks, mining companies, and professional traders, these contracts are tools for speculation or managing risk, not for collecting physical metal. Here's the key point most people never realize. The vast majority of these contracts never end with anyone taking delivery of actual gold. Instead, they're closed, rolled into a later contract, or settled financially before the delivery date ever arrives. The trade ends, profits or losses are booked, and everyone moves on. Imagine reserving a hotel room every weekend for an entire year, but canceling every reservation the day before you arrive. Sounds strange, doesn't it? Yet that's surprisingly similar to how many futures contracts have traditionally worked. The contract matters. The physical product usually doesn't. For decades, that system functioned smoothly because participants shared one important belief. The paper contract was good enough if you wanted exposure to gold. Owning a contract was often more convenient than storing heavy bullion, paying insurance costs, or worrying about security. As long as confidence remained high, very few people had a reason to ask for the real thing. And that's exactly why what happened next caught the market's attention. Because when more investors suddenly begin saying, "No, I don't just want the contract, I want the metal," they're signaling something deeper than a simple investment preference. They're revealing a shift in confidence. And when confidence begins to change, history suggests it's worth asking one important question. What do the people closest to the market see that everyone else is missing? That's where this story becomes far more interesting. For years, the unwritten rule of COMEX was simple. Trade the contract, not the metal. Then the pattern started to change. Instead of quietly closing their positions before delivery, an unusually large number of market participants began standing for physical delivery. Even more surprising, this demand wasn't limited to the major delivery months. Months that have historically seen relatively light delivery activity suddenly experienced remarkably strong physical demand that caught the attention of experienced market observers. Why? Because institutions rarely change their behavior without a reason. They have access to vast amounts of research, economic data, and risk analysis. They don't move billions of dollars based on social media, trends, or emotional headlines. When they adjust how they manage risk, it's usually because they're preparing for possibilities that the broader market hasn't fully priced in yet. So what could they be preparing for? The answer isn't one single event, it's the combination of several powerful forces reshaping the global economy. Inflation may have cooled from its peak, but concerns about the long-term purchasing power of currencies haven't disappeared. Government debt continues to grow. Geopolitical tensions have made global trade less predictable. Supply chains remain vulnerable to unexpected disruptions, and countries around the world are increasingly thinking about how to reduce their dependence on a single reserve currency. At the same time, central banks have been buying gold at historically strong levels, steadily increasing their reserves as part of a broader effort to diversify national assets. Think of it like packing for a road trip. If you see someone bringing an umbrella, it doesn't necessarily mean it's raining. But if millions of people suddenly start packing umbrellas on a sunny morning, you'd probably wonder if they know something about the forecast that you don't. That's how professional investors view market behavior. They don't just watch what institutions say, they watch what institutions do. And one of the clearest signals is this. When more participants choose physical possession over paper exposure, they're placing greater value on certainty. That doesn't automatically mean a financial crisis is around the corner. It doesn't prove that markets are about to collapse. But it does suggest that trust, arguably, the most important asset in any financial system, is being evaluated more carefully than before. Because every financial system ultimately depends on confidence. Confidence that a currency will hold value. Confidence that contracts will be honored. Confidence that markets will continue functioning as expected. When confidence is abundant, paper promises are often enough. When confidence becomes more uncertain, ownership itself becomes more valuable. And that's the lesson many investors overlook. The biggest opportunities don't always begin with dramatic headlines. Sometimes, they begin with a quiet change in behavior that only becomes obvious when you zoom out. And once you see that shift, the next question isn't whether gold will go up tomorrow. It's what this changing behavior says about how the world's largest investors are preparing for the decade ahead. At this point, it's tempting to jump to the most dramatic conclusion. Does this mean the financial system is about to collapse? Not necessarily. History teaches us that markets are rarely that simple. Strong physical demand on COMEX doesn't guarantee an economic crisis. It doesn't mean paper markets are failing, and it certainly doesn't mean every investor should rush out and buy gold tomorrow morning. But dismissing these signals entirely could be just as dangerous. Because markets often communicate through behavior long before they communicate through headlines. By the time television anchors start calling something the biggest financial story of the year, institutional investors have usually been adjusting their positions for months or even years. That's the difference between reacting to the news and recognizing a trend. The world's largest investors don't build strategies around what's exciting today. They build strategies around what could matter 5 or 10 years from now. Think about a GPS. If it quietly tells you there's heavy traffic 10 miles ahead, you don't wait until you're sitting in the traffic jam before changing routes. You make the turn while everyone else keeps driving straight. Successful investing works much the same way. It's less about predicting the future with perfect accuracy and more about preparing for multiple possible outcomes before everyone else realizes they should. That's exactly why institutional behavior deserves attention. Large pension funds, sovereign wealth funds, central banks, and major asset managers aren't trying to win next week's news cycle. Their job is to preserve wealth through uncertainty. When they become more focused on resilience, liquidity, diversification, and tangible assets, they're revealing something important about how they view the world's evolving risks. And that's a mindset ordinary investors can learn from. Not by copying every trade, not by chasing every commodity, and certainly not by believing every viral prediction that appears on your social media feed. Instead, ask a different question whenever you see major institutions making consistent moves. What risk are they trying to reduce? That single question can completely change how you look at investing. Because wealth isn't built by reacting to headlines. Headlines are designed to capture your attention. Capital flows reveal where conviction actually exists. When billions of dollars quietly move in one direction over months or years, that's often a far more meaningful signal than a one-day market rally or a sensational headline screaming that everything has changed overnight. The investors who build lasting wealth understand this difference. They spend less time predicting tomorrow's price and more time studying long-term behavior. They understand that markets move in cycles. Confidence rises. Confidence falls. Policies change. Technologies evolve. Geopolitical alliances shift. But one principle remains remarkably consistent. The people who pay attention to how capital is positioning itself often recognize major trends before they become obvious. That's why the real lesson from COMEX isn't simply about gold. It's about learning to observe the market through the eyes of institutions instead of through the emotions of the crowd. Because in investing, your greatest advantage rarely comes from knowing a secret. It comes from noticing what everyone else is overlooking. So don't obsess over every price swing. Don't panic over every breaking headline. And don't mistake short-term noise for long-term direction. Instead, develop the habit that separates disciplined investors from emotional ones. Don't copy billionaires' portfolios. Copy what they're preparing for. If today's story made you wonder why institutions are placing greater importance on gold, the next piece of the puzzle is even more revealing. Because while investors have been watching comics, central banks have quietly been buying gold at a pace that surprised markets around the world. Click the video on your screen. Breaking: central banks just bought more gold than anyone expected. To discover what they're preparing for and what it could mean for your financial future. I'll see you there.